Do you want to build a robust dividend investment portfolio with growth stocks? Welcome to the world of dividend investing, where the magic happens. It's a strategy that can provide both immediate and long-term rewards, creating a secure financial cushion for your future. In today's video, we're going to deep into the world of dividend investing, starting from the ground up. We'll walk you through dividends, stocks, and how they come together in investing. We'll break down the benefits of this type of investing, showing you how you can generate a steady income stream whilst retaining the chance for price appreciation. We'll guide you on how to choose the right dividend stocks, tailored to unique financial goals and risk tolerance. We'll also teach you how to build a robust portfolio and, most importantly, how to monitor and manage it effectively. We'll provide you with practical tips, strategies, and insider knowledge, all designed to help you make informed decisions about your investments. And remember, dividend investing is not just about making money, it's about making your money work for you. By the end of this video, you'll be well on your way to building a strong dividend investment portfolio. First off, let's understand what dividend stocks are. They're a fascinating investment opportunity with a unique method of generating income for the shareholders. Picture this scenario for a moment. You're part owner of a thriving business. As part of your ownership status, it stands to reason that you'd be entitled to a certain percentage of the profits your business generates, right? That's the basic premise of dividend stocks. When a corporation turns a profit, a decision has to be made. What do they do with this newfound wealth? They have a couple of options. They could choose to reinvest it into the business, fueling growth, innovation, and stability for the future. Alternatively, they may elect to distribute a portion of these earnings back to their shareholders. These payments, made to shareholders as a reward for their investment and trust in the corporation, are what we know as dividends. Owning dividend stocks, therefore, means you're essentially being paid to keep hold of those shares. It's like having a dessert and being allowed to eat it as well. You have ownership in the corporation and the added bonus of being compensated for it. However, it's important to note that not all corporations choose the path of distributing dividends. Some opt to plow all their profits back into their business, fueling expansion plans, furthering research and development, or paying off any existing debt. These corporations tend to issue what are known as non-dividend stocks. In such cases, the primary way that investors see a return on their investment is through an increase in the stock's price. Therefore, dividends aren't always a guarantee in the stock market. It is largely dependent on the corporation's policies and strategies surrounding profit distribution. The next big question is, how do we gauge the dividends a company disperses? This brings us to the essential concepts of dividend yield and payout ratio. The dividend yield is effectively the annual dividend payment divided by the stock's current market price. This gives you an indication of the return you're getting on your investment by way of dividends. The payout ratio, on the other hand, is the percentage of earnings a company distributes as dividends. It's calculated by dividing the annual dividends by the company's net earnings. This ratio is an excellent indicator of how sustainable the dividends are. If a company is distributing more in dividends than it is earning, that could be a potential warning sign. In the vast and complex world of investing, there's no single strategy that suits everyone. Some investors may be drawn to the potential price appreciation of non-dividend stocks, while others might appreciate the consistent income stream generated from dividend stocks. The choice is largely dependent on your individual investment goals and tolerance for risk. Now that you understand what dividend stocks are, let's move on to why you should consider them for your portfolio. So, why should you consider dividend investing? A question that potentially lingers in the minds of many, particularly those contemplating various investment strategies. Let's navigate through this intriguing subject to highlight the various potential benefits it offers and why it's an investment strategy worth delving deeper into. Firstly, we'll talk about how dividend investing can construct a steady and robust stream of passive income. Passive income, as the term conveys, is the income you receive without the necessity of actively working for it. It's the money that trickles into your bank account while you're busy doing other things or even while you're asleep. This is how it works. When you invest in a company that's doing well, a percentage of the profit they make is returned to the shareholders in the form of dividends. As a devoted investor, you can eagerly look forward to these payouts, which usually occur on a quarterly basis. These payouts are akin to a pat on the back for your trust and loyalty towards the company. This consistent stream of passive income can cover your day-to-day expenses, supplement your lifestyle, or even be tucked away for future contingencies. Secondly, dividend investing also opens the door to a world of reinvestment opportunities. Whenever you're the recipient of dividends, you have the choice to reinvest them back into the company to purchase additional shares. This mechanism is popularly known as a dividend reinvestment plan, or DRIP, to keep it short and sweet. DRIP acts as a potent tool enabling you to benefit from the wonders of compound interest, an investor's best friend. As time goes by, your investment starts expanding, not just through the appreciation of the company's capital, but also due to the increasing number of shares you own thanks to the DRIP mechanism. Lastly, but certainly not the least, dividend investing can pave the way to capital appreciation. While dividends contribute significantly to your investment returns, they are just a slice of the whole pie. As the company slowly but surely expands, becomes more profitable, and establishes a stronghold in the market, the value of its stock generally sees an upward trend. This implies that the price of the shares you own also follows suit, culminating in capital gains. However, it's crucial to bear in mind that dividend investing is not devoid of risks. Companies may decide to slash or completely do away with dividends during financially challenging periods, and stock prices are prone to, but with judicious selection and diversification, you stand a good chance of reaping rewards that significantly outweigh the potential risks. Evidently, dividend investing is a compelling strategy. It equips you with a passive income stream, offers reinvestment opportunities, and holds the promise of capital appreciation. In the financial world, akin to having your cake and eating it too. Next, we'll delve into the art of selecting the right dividend stocks. So, stay hooked, and let's continue our thrilling exploration into the captivating universe of dividend investing. Choosing the right dividend stocks is crucial to your investment success. To increase the chances of success in your investment journey, it's essential to understand and apply key factors in the selection process. This discussion aims to provide you with a comprehensive guide on what to look for when choosing the right dividend stocks. Firstly, a critical factor to consider is the company's overall financial health. A company that is not only profitable but also demonstrates stability and consistent growth is a wise choice for dividend investment. One of the best ways to assess a company's financial standing is by analyzing their balance sheets, income statements, and cash flow statements. Such documents provide an overview of their financial situation, operational efficiency, and how well they manage their resources. A company with a strong financial foundation is usually dependable and more likely to pay consistent and growing dividends, providing investors like you with a steady stream of income. Next, the focus should be on the dividend yield. This is an essential metric for investors because it represents the annual dividend payment divided by the stock's current market price. While a high yield might seem appealing since it implies a promising return on investment, it's important not to become overly fixated on this single factor. A high dividend yield can sometimes be a red flag, indicating that the company could be in financial distress. Therefore, balancing the hunt for yield with other critical factors is essential in preventing potential pitfalls in your investment journey. Now let's delve into the payout ratio. This ratio is the proportion of earnings a company pays out as dividends to its shareholders. A low payout ratio can suggest that the company has plenty of room to increase its dividends in the future, indicating potential for growth in your income over time. However, a high payout ratio could imply that the company may be straining to make dividend payments, which might not be sustainable in the long run. Thus, understanding the payout ratio provides valuable insights into a company's ability to maintain or increase their dividends. Lastly, consider the dividend growth rate. This rate tells you how much a company's dividend payments have increased over a particular period. Companies that have a history of routinely increasing their dividends are often well-managed, financially sound, and are likely to provide a reliable income stream. Remember, a steady increase in dividends can significantly amplify your income over time, further contributing to your investment success. In conclusion, choosing the right dividend stocks involves carefully considering the company's financial health, the dividend yield, the payout ratio, and the dividend growth rate. By thoroughly understanding these factors, you can gain valuable insights into the company's ability to maintain and even grow its dividend payments, ultimately leading to a more successful investment experience. Armed with these selection criteria, you're ready to start building your dividend portfolio. Remember, the journey to dividend investing success can be thrilling and highly rewarding with the right approach. So let's embark upon your path to financial independence through astute dividend investing. Now, it's time to build your dividend portfolio. Embarking on this venture is an exciting endeavor, but it's crucial to understand that this is not a fast-paced, adrenaline-pounding sprint. It's a marathon. The road to a successful dividend portfolio requires a deep understanding of the market, an appetite for patience, and a solid strategy. The first crucial step towards building your dividend portfolio is diversification. It is akin to the old saying, "Don't put all your eggs in one basket." Rather than focusing your investments in a single sector, strive to spread your investments across a variety of sectors. These sectors can include but are not limited to healthcare, technology, consumer goods, energy, and financial services. This strategy helps to buffer the risk associated with market volatility and ensures your investments aren't entirely dependent on the performance of one sector. It also maximizes potential returns by leveraging growth opportunities across the market. Next, consider reinvesting your dividends. This is perhaps one of the most powerful tools for growing your portfolio over time. By reinvesting, you're essentially using the dividends you earn to buy more shares of the same stock. This creates a compounding effect where the dividends from your newly acquired shares generate even more dividends. It's a beautiful cycle that, when implemented consistently, can lead to exponential growth and substantial wealth accumulation over the long run. However, as we delve deeper into the art of dividend investing, it becomes increasingly clear that patience is a critical virtue. Rome wasn't built in a day, and neither will your dividend portfolio. You see, companies that regularly pay dividends are often mature and stable. They may not showcase the rapid share price growth that younger, more volatile companies might. However, they make up for by consistently doling out dividends that can act as a steady income stream or be reinvested for future growth. When we talk about long-term investing, we're referring to the practice of holding on to your investments for several years or even decades. This strategy allows you to weather the storm of market volatility and benefit from the power of compounding dividends. Over time, your dividends can earn dividends of their own, creating a snowball effect that can significantly enhance your wealth. Lastly, it's essential to continuously educate yourself. Stay updated on market trends, monitor your investments regularly, and adjust your portfolio as needed based on evolving market conditions and your personal financial goals. And remember, don't be discouraged by short-term market fluctuations. It's the long-term trends and your overall investment strategy that truly matter. In conclusion, diversifying your investments, reinvesting your dividends, exercising patience, keeping a long-term perspective, and consistently learning about the market are the to a successful dividend portfolio. Remember, building a dividend portfolio is a marathon, not a sprint. Once your portfolio is set up, it's essential to continuously observe and revise it as necessary. This isn't just a one-time task, but an ongoing process, much like maintaining a well-tended garden. Just as a gardener frequently monitors the health of his plants, adjusts their positions to benefit from optimal sunlight, and remains alert about potential threats, the same principle applies to an investor and their dividend portfolio management. Every day in the world is a new adventure, and the only way to navigate through is by staying vigilant. Monitoring your dividend portfolio is not just about passively watching the numbers escalate and descend. It's about interpreting these fluctuations, pinpointing their causes, and understanding the implications these changes have on your financial objectives. In the investment world, you're not a mere spectator, but an active participant in your financial journey. You take the wheel and steer your investments towards your desired financial destination. Regularly reviewing your portfolio is an integral part of this journey. This does not mean you need to obsessively check your stocks every second, but dedicating a particular time slot, week or month to review your investments can be beneficial. Your review sessions should not only focus on your current holdings, but also on exploring emerging opportunities. The financial market is ever evolving, with new dividend-paying companies appearing on the scene regularly. Being open to adapting your holdings as the market conditions change is a vital part of portfolio management. If a company you've invested in starts demonstrating signs of financial instability or announces a reduction in its dividend, reevaluating your investment might become necessary. The primary objective is to create a reliable income stream. If a particular stock stops serving this purpose, it might be time to reconsider and possibly let go. Staying aware about your investments extends beyond merely knowing the current price of your shares. It involves understanding the company's financial health, its prospective future, and its role in the broader economic scenario. The more in-depth your knowledge about your investments, the better equipped you'll be to make well-informed decisions. Thus, it's crucial to read those quarterly reports, stay updated with financial news, and never hesitate to seek clarifications. Always remember, your portfolio is a mirror reflecting your financial objectives and aspirations. Regular monitoring, adaptation, and diligent management can ensure that your dividend portfolio continues to expand, providing you with a steady income stream. It's not just about making investments, it's about managing them wisely to ensure that they work effectively for you. With diligent monitoring, your dividend portfolio can continue to grow and provide you with a steady income stream. The key is to remain involved, stay informed, and remember that your portfolio is a reflection of your financial goals and aspirations. Over time, with consistent effort and attention, your dividend portfolio can become a pillar of financial stability and growth in your life. Let's recap what we've delved into today. Our journey began with an exploration of the concept of dividend investing. We've come to understand it as a thoughtful, strategic approach to investing, one where you buy stocks from companies with a consistent habit of sharing a part of their earnings with shareholders in the form of dividends. This is an exciting way of generating passive income, a concept that is undeniably enticing to many, who, after all, wouldn't want to earn while they sleep. Moving forward, we plunged into the intricate world of dividend stocks, identifying them as shares in companies that have made it a regular practice to pay out dividends. These corporations are often quite stable, having established a reputation for generating steady profits over time. More often than not, these are the types of companies that operate within well-established industries, those that have proven themselves capable of navigating through economic downturns. Our conversation then shifted towards the wide-ranging benefits of dividend investing. It's crucial to remember that it's not solely about the stream of income, regular though it may be. There's also the incredibly important aspect of compounding, a concept that can make your investments grow exponentially over time. By reinvesting your dividends to buy further shares, you are effectively generating more dividends. This cycle, if maintained and handled correctly, can lead to substantial wealth accumulation over a long period. The dialogue then transitioned to the topic of choosing the right dividend stocks. We stressed the significance of looking at a company's dividend yield, its payout ratio, and its growth rate. It's not just about blindly choosing the company with the highest yield, but rather about seeking a balanced approach. It's about finding that sweet spot between a company's ability to consistently pay dividends and its potential for growth. This is where your research skills and financial knowledge truly come into play. Once we had shortlisted our potential stocks, we then discussed the process of building your personalized dividend portfolio. This, in essence, is where you decide how much to invest in each stock, keeping in mind the pivotal role of diversity. It's not a wise idea to keep all your eggs in one basket. By distributing your investments across various industries, you're able to dilute risk and increase your chances of stable returns. Finally, we discussed the importance of monitoring your dividend portfolio. This is not a one-time investment strategy where you can make an investment and then simply forget about it. Regular reviews and adjustments are necessary to ensure that your investments are still in line with your evolving financial goals and to make any required changes. With these steps and reminders, you're definitely on the right path towards building a robust dividend investment portfolio with growth stocks. We hope that you will use this knowledge wisely in managing your financial investments. Invest wisely and happy investing.